Hi, I'm Erwin. This is the Stock Hacker Academy show. I think that's the name of the show. We're running with it for now. This is my friend Joel, who's part of Stock Hacker Academy, of course. And we're here to talk about interest rates, yield curves, and possible recession.
Yeah, hopefully not. Hopefully not.
Hopefully not. But it doesn't mean we can get more deals.
Oh, could present opportunities.
Yeah, and that's why mostly cash. But we'll get into. But once we dig into where we see things where things are today with inflation and interest rates, then that kind of alludes to why I'm mostly cash. Mm-hmm. Yeah. So where should we start, Joel?
Interest rates in general, federal policy rates. I mean, that's the easy one, and then we can talk about some things that are indicating possible recession. But we know that interest rates are rising. That's on every headline. For weeks, whenever the Federal Reserve and the Central Bank of Canada make a move, and we expect that that's going to continue happening. I think an important discussion is, why is that happening?
Yeah, why is that happening, Joel?
So, I mean, we know that inflation is insane on a experiential level.
Yeah.
You go out anywhere and prices are just higher almost no matter what.
Yeah. For many reasons.
For many reasons. So the central banks feel like they need to do something about that.
And they should.
Try and wrangle things in. Their biggest tool is their policy interest rate. And they raise that. It raises the cost of borrowing. So whenever an individual or a business goes out to borrow money from a bank, the interest rate on that debt is higher. So it makes businesses think twice about whether or not they can afford to borrow more money. Mm-hmm. And that's where people can get skittish because it also raises interest rates on debt that already exists. That's where it can affect stocks as well.
Yeah, I have lots of debt. I have millions in debt. I'm actually not too worried about this though. And for anyone who attended Cherry and I's real estate meetup on the weekend, we actually discussed, and I shared a chart where the Federal Reserve of the U.S., their central bank, they created over 41% new money from January 2020 till February of 2022. So there's brand new money supply of 40%. That may explain some of this money supply and increase in causing inflation. And I'm not arguing whether or not we should or shouldn't have. Any government shouldn't have done this. I actually think they should have. I'll agree with Warren Buffett on that. Things could have been a lot worse for life and people's livelihoods and families if governments didn't print this money. But now we're living the results of it.
Yeah. Have a Reuters article up here talking specifically about the U.S. Treasury yield curve inverting, and we'll step into that in a minute. But it mentions that inflation, the Federal Reserve, is attempting to bring down inflation from 40-year highs. We've never seen these numbers before.
It's absolutely crazy. These are historic times.
Yeah.
Right? We had historic, again, a fact that I shared on the weekend with our real estate meetup was the pandemic was the first time since, I think, the Spanish flu where the average expected life declined. Right? So we've been on a great run. Mm-hmm. And just a quick side note, life is better than ever. Yeah. And people are richer than ever. So I know the last 2 years have been tough for many, but if you zoom out and look at the last 100 years, life's pretty good.
Yeah, absolutely. So the biggest piece is if you're in stocks or real estate, what do rising federal interest rates mean for you? The short answer is your mortgage rate's going up if you have properties, and your stocks are probably going to dip if you own stocks. Now, that's a blanket statement for thousands of companies, so obviously it's not true across the board.
No.
Some companies are more sensitive to interest rate hikes than others. Now, I thought it was just because the cost of borrowing, but you also brought up a good example about there's actually priced in. So there's two factors here. There's the federal policy rate, and then there's also the bond rate. And I thought it was just because cost of borrowing goes up. Growth companies who rely on debt to fund their operations. They're not profitable yet. They might have cash flow, but their expenses still exceed their revenue. Their cost of borrowing goes up, their expenses go up, they're more vulnerable. But you were also mentioning there's a broader price and market return calculation involved.
Okay, so I'm going to get a little bit textbook on folks. Capital asset pricing model, CAPM, is a formula very commonly used for pricing a stock. And one of the inputs to the CAPM is what's called the risk-free rate. So this would be generally what's considered risk-free, government bonds. You and I can argue how risk-free they are, but for a textbook conversation, government bonds are considered risk-free. And so if the risk-free rate, if bonds are returning more money, then that looks to be a more attractive investment compared to whatever stock we may be evaluating, especially growth stocks that don't make money versus government bonds do pay money. so a growth stock looks as a less attractive investment based on textbook stock calculations.
So this is where the federal interest rate and the yields that we're seeing on bonds kind of collide. Obviously, they're going to play off one another anyway. If interest rates are climbing on the federal level, people might, and we see high inflation, people might choose to go to quote unquote safer investments like bonds anyway. So they're buying in, therefore yields go up on. Now, what's interesting, although actually I don't want to skip over this, you had a really good comparison to cap rates versus this CAPM formula. Is it just that it's imperfect for an exact value of an asset?
Right. I keep I keep saying how the capital asset pricing model is textbook, no different than using cap rates to value apartment buildings is textbook valuation methods. While both have some merit, both can also be manipulated. Yeah. Especially in real estate, where it's not audited. The example I gave Joel, for example, was if a landlord of an apartment building doesn't pay themselves a salary for managing the property themselves, like doing repairs themselves, then the valuation of the building's off. Like it's missing expenses. That's just one example. And there's many examples that I've seen in my history of being a real estate investor. And then in the example of CAPM, there's the inputs that are so variable. What time period you're looking at? Are we looking at 3-month or 10-month? Like what stock are we looking at? And then there's all these other factors that are playing into the world. Like I invest in Chinese stocks, for example, and then all the headlines saying that U.S. may delist Chinese stocks. That's a bigger influence on the stock than some textbook stuff that we talk about using calculations. Or there's this war in Ukraine that may affect oil prices and oil stocks a lot differently than a lot of stuff that we learn in textbooks and using these formulas. So again, these are just guidelines really, and then just to explain to folks, textbook math isn't perfect, but it can be used to. I mean, we're just using it as an analogy to try to bring it back to real estate investors.
Yeah, and I think the important point too is that this is where it all collides, because interest rates are important even in a cap rate. Like this, usually you can boil down a quick calculation of whether a property is going to be profitable or not based on the interest rate you can get on your debt versus the cap rate. So if the interest rates are going up, that's going to put pressure on quote unquote is going to put pressure on cap rates. It's going to be harder to find profitable deals.
For buildings, yeah.
Exactly. Yeah. So with stocks, with this CAPM model, not only do rising interest rates affect the actual borrowing rate and expenses of most companies, it also affects how big time investors and institutional investors are actually evaluating what the price of certain companies in the market should be. And so one of the elements in that calculation is bond rates. So this is where bond rate and inflation or federal interest rate collide. On Tuesday, it was brief. I'm going to go back to this Reuters article.
Because anyone who follows the news knows that this is happening. We follow the news. We do try to filter out some of the crazy stuff.
This, what are the numbers? This is always kind of what I'm looking at. What are the numbers? And then who's reporting the numbers? That's a big deal too. I trust Reuters. They're a global, to a certain extent, they're a global news agency. Well, technically, they're a global data agency. That data is their primary business model. And they're Canadian. Well, they started out as Canadian, but that's besides the point. They have this fantastic article about the inverted yield curve and the fact that, actually, I guess we should probably define the inverted yield curve.
You want to do it or should I do it?
So there are multiple, I don't fully understand bond rates. I've never personally looked into like buying bonds. They've always seemed boring to me. But I know that there are different like maturity periods. So 2-year, I guess there's like even like 3 and 6 month and 9 month.
Yeah, there's many terms. It's just the most popular for the market is to look at the 2-year bond yield, comparing it to the 10-year.
Okay.
So 2-year considered short term, 10-year considered long term.
So usually, if you have your money tied up for a longer period of time, you want a better yield. You want more return on your money. And that's usually the case. 10-year bonds, you buy those, you're going to get a slightly better yield than a 2-year bond. On Tuesday, that spread, so the graphic that you see here between the U.S. Treasury yield curve, usually there's more value in the 10-year. Well, for a brief moment on Tuesday, there was actually more value in the 2-year. So you made a really, like, I didn't fully, I can look at the graphs, I can look at the data, I'm like, so what? Like, what does that really matter? But you made a really good point about future expectations, investors' future expectations.
The market's basically saying their expectation for the future is worse than the next 2 years.
Which is bizarre. I never pinned it like that before.
Yeah, and that's why so many investors and why this yield curve inversion talk is making so many headlines. And then why is it important? Because I know you prepared with the chart on that.
Yeah. So here, capitaladvisors.com, they in 2017 they released a report, and this is the graphic you can see now. History of what this inverting yield curve means for the market and for the economy in general.
Yeah. So when the market believed that the future was worse than the present term, than the next 2 years, it's actually accurately predicted recessions.
Almost every single recession since 1955. There was one false positive in the 60s, which is a crazy win rate. And so this what you see on your screen, this green line is the spread between the 2 and the 10 should be positive. Whenever it dips below into the negative territory. So this is from 1977 up to 2005. And actually, I think we can just see 2007. You can see at the very end of this chart, you see it just starting to touch that 0 part and dipping below. That'd probably be 2007, which is again when obviously, we had recession in 2008.
Financial crisis.
So the green line is the yield curve. When it dips below that zero line, it's inverting. The gray bars underneath are recessions. And so a very, very good track record for this predictor. They say anywhere between 6 to 24 months is usually when recession is coming.
Right. So can we talk about what we should do as investors to prepare for
this? Probably a good idea. Yeah.
So I'll share what I'm doing, and I'm not an expert, folks. So Cherry and I, we are refinancing a couple of our properties to pull equity out. And then my hope is to sit on some of that as cash. Cherry wants to buy more properties. And stock-wise, I'm about 50%. I'm 60 to 50% cash. Sorry, probably the inverse of that. I'm 40 to 50% cash. So I'm cash heavy, even though I don't want to be holding cash. I'm just being cautious.
Mm-hmm. I'll admit I've been tempted with the last 2 weeks have been pretty green in the market, and it's such a relief after Coming out of January and February, they were harder months, correcting pretty hard at certain points. So there's this like urge to jump in, but there are these signals, among others, that more pain could be ahead. So I'm about 60, maybe if not 70% cash as well in my options portfolio. I probably should put a little bit more cash in the TFSA to get ready. That's kind of my personal thought process. It's not a recommendation, but if we do see some kind of dip again, the opportunity is, getting in on companies that will be able to weather whatever storm is coming and getting in at really good prices.
Yeah, and then based on today's exchange rates and where prices are, I'm looking at really boring stuff.
Really boring. Who has dividends? Who's been paying out dividends solidly for the last 25 years?
Who's got dividends? Who's well prepared to? Who's doing good business in China? Things, companies like that.
I'm not an expert, but one of the stats I've been looking at is what's the book value of a company, and if it's and then how much cash do they have sitting around. Buffer. It was actually something I was thinking about on the dealing with Toronto traffic. Like buffer and traffic, buffer and everything in my investing too, and that's something I've learned over the last year and a half, but also in the last few months. Even though it's not as attractive, the returns aren't as attractive. More buffer generally means you come out ahead in the long term. So
nothing wrong with that.
Yeah.
I'm cautiously optimistic.
Yeah.
This isn't a recession for sure.
Yeah, there's no way we can absolutely say that this is going to happen. There are certain statistics that say it could, so we prepare, and that's all we can say.
Mm-hmm. And then again, I think it depends on your portfolio.
Yeah.
I'm very heavily invested in hard assets, and I feel sorry for anyone has very little hard assets.
Yeah, we don't know what this is going to do to volatile and speculative investments, so we stick with the safe stuff for now.
All right. And if folks, you've enjoyed that, you want to stay in tune with the market, what we're looking at as professional investors, then like and subscribe.
Absolutely. And you can subscribe to, we have a Stock Hacker report that goes out every week. There'll be a link below for you to subscribe to that. It'll also give you a free case study for signing up, so it's not just giving over your email address for nothing. But that way you can stay in tune with kind of the stuff that we're looking at as well.
Is this one Battle of the Side Hustles?
Yeah, we'll do the Battle of the Side Hustles, or as we call it, the ultimate side hustle for Canadians. It compares 4 side hustles side by side, real life numbers, time commitment, money commitment, actual capital investment, and the returns that this investor particularly saw from each side hustle. So
yeah, I'm all about the side hustle.
Yeah, stack the strategies. We talked about that in the last video. Stack those strategies. So
all right, thanks, Joel.
Yeah, thanks everyone. See you everyone.